Okay, let's get started here in we're doing week 11 material. It's chapter 10 in your textbook, and we're going to be dealing with corporations with stocks this time, and corporations issuing their own stock to raise money. So that's one of the ways you can raise money. The other way is by selling bonds, which we've already talked about. So these are the two ways to really raise big amounts of money. But before we get into that, I wanted to review some of the overall concepts of the corporation, just so we understand where things are coming from, a couple of the terminology. I think that'll be important as we go along. So the first thing is a corporation. Remember, that's one of the ways to form a business. The first way was forming it as a sole proprietorship. It means you're the only owner, you're the boss. It's very easy to form, but it's hard to raise upfront capital, upfront money. The second way is a partnership, where you and others come along and are multiple owners. Could be two, could be a lot more than two. It's still pretty easy to form a partnership. The accounting for it gets a little more complicated, and it's a little easier to raise money because there's more than just one person the bank can fall back on if the business doesn't do well. And then one of the final ways to form a for-profit business is a corporation. The corporation, what that is a separate legal entity unto its own, in that if something happens in the business, individuals who are harmed can sue the corporation. The corporation is its own entity. And therefore, the individual owners of the business are somewhat protected. How it's different than is if you are an individual owner of a sole proprietorship and you don't have special protection, what's called LLC or LLP, then individuals, if they're harmed by your business, can sue not only your business, but also sue you personally. This corporation kind of helps alleviate that, except in the instances of fraud, where an individual goes out and harms others knowingly. Some of the big key items in a corporation, and part of why they're a separate legal entity for one of the big cases is legal issues, is the stockholders don't really run the business. The stockholders elect a board of directors. These stockholders are just the money people. All they do is invest money. They don't have really hardly any say in how the business operates. They elect the board of directors to do that for them, because usually the money people know how to control their money, know who to invest in, but may not know how to run a corporation. That's what the board of directors are there for, and then the board of directors hire all the upper management, like your CEOs, your CFOs, who run the day-to-day part of the business. So there's definitely advantages to being a corporation. When you are a corporation and if you issue stock, you can get lots of upfront money and have no debt. Because when you issue stock, you're issuing part ownership. You don't have to pay that back. You can transfer ownership pretty easily. That's another big one. You can just sell your stock and therefore ownership is transferred. In a partnership, it's not like that. Why not a corporation? There's a couple biggies. There's a lot of government red tape. You're going to have to fight off and do a lot of regulations within a corporation. Earnings are double taxed. That's another biggie. And another one is, with a corporation, you are giving up ownership, kind of like in a partnership, but ownership, whenever the company sells stock, your piece of the ownership has dwindled down. So a few things to have to start up a business. You need to be a corporation. You have to file what's called the Articles of Incorporation. And you can look that up. I'm not going to go through that. But here's a couple of items that are definitely needed that you would then file within the state that you want to be located. So these are the overall rules of the business, the overall not necessarily rules, the overall understanding what the business is even there for and who's in charge of it, and then how the business will operate is done more in-house. Not so. These are public. These are made public known. These are more in-house, and they can be changed a lot more easily. Okay, so in this chapter we're going to be issuing stock, and so a couple of the key things we need to know is some stock terminology. And stock usually has phases. How often? They have phases of when they're issued, how many can be issued, and then eventually, if they're ever retired, it means they're no longer going to be issued. So a company, when they start out in their articles of incorporation, they're going to need to decide as one of their items how many stock can be issued. Basically, that's to keep from some maybe deception going on. You don't want to say, I'm only going to issue 1,000 shares of stock, and then somebody comes along and buys 500, so they assume they have 50% ownership, and then the corporation says, I changed my mind, it's not going to be 1,000, it's going to be 10,000. So that person who had 500 shares and thought that they owned 50% now only own 5%. So you need to have a set number of stock out there, and it may be quite large because you just don't know how many shares you want to issue, and then you just issue them a little bit at a time. So you need to have a set number, and that's going to be in your articles of incorporation. And then once you do issue some of your stock, it's called issued stock. It's pretty easy to remember. So issued stock stays on your books. As soon as you sell it, and we're going to show that how that's journalized in a little bit, as soon as you sell it and you journalize it, that stock stays there. Now it may move around a little bit. If you buy it back, it may move to a different category temporarily, but it's still going to remain on your books. The only time issued stock ever comes off your books is if basically the company says, that stock, I want it retired, and I'll never issue it again. So therefore, the authorized number of shares goes down, because if you're never going to issue that stock again, then of course the number of shares you have left to issue are dwindling. So there's issued stock is when we actually issue it, but it may or may not be still in the public hands, depending on if we buy it back. Outstanding stock tells us of the shares that are issued, outstanding means how many are still in the public hands. So they're still sold, and we, the corporation, have not bought them back. Because if the corporation buys them back, that's called Treasury Stock. So you buy back your own shares, and there's various reasons why a company may buy back their own shares. But it's kind of temporary. You expect to resell these shares at some point. If you don't expect to resell them, then you go ahead and retire them. But you do expect to resell them at some point in the future. So what that means is if they're in Treasury stock, they're still considered issued. They're just no longer outstanding at the time being. Okay, so the two types of stock that a company may issue. The first one that we're going to talk about is common stock, and this is the default. So if there's only one type of stock out there, this is the type that you would have to have. You can't just have preferred. So common stock, a couple of the items about it. This is the ultimate ownership. If you own common stock, you are a part owner. This is more not really ownership. This is just more of if I'm going to get dividends. I don't really have a say in the company if I have preferred stock. I'm just basically there as a money person, and I'm going to give you money, and then in return you're going to give me back some dividends, and hopefully my shares value will go up as well. These guys not only invest money, but they also vote on who's going to be the board of directors. They make some of the ultimate voting things that are big voting things, like who's going to be on the board, because the board actually controls what's going on with the corporation. Neither group has guarantees to dividends. So common stock, if the company doesn't give it out dividends, they don't have to. Therefore, the common stock are just out that year. Same with preferred. Preferred stocks aren't guaranteed dividends. However, one of the big differences between common and preferred, common Common stock gets all the dividends that are left over. So if there's a whole bunch of dividends left over, they're going to get it all. What I mean left over is because preferred stockholders get their dividends first, and they get a stated rate of dividends. They know before dividends are even given out, when they buy their stock, they know as long as dividends are issued, they're going to get, let's say, $50 are issued, and their stock says, for any time shares of dividends are issued, you're going to get the first 20 bucks. And then whatever's left goes to the common stockholders. So if 50 bucks was issued in dividends, preferred stockholders get the first 20. And then the common stockholders will fight over the remaining 30. If there was only 25 in dividends given out, these guys still get the first 20. These guys only get 5. So that's why these guys have the ultimate risk or reward, depending on how much is given. These guys are a little less risky. Preferred either are considered cumulative or non-cumulative when it comes to dividends. If they're cumulative, that is by far the better option for preferred, because then they get dividends in arrears, which means they get past dividends. If they did not get dividends the year before or didn't get their full 20 bucks because not even 20 bucks was issued in dividends, they get to go back to last year when collecting for the new year, collect those first, then collect this year's before common stockholders even get anything. So cumulative is by far the better option for preferred. But if you're buying common stock, you would hope that the preferred dividends are non-cumulative. So if last year's people missed out, then they're just the same as you, because common stockholders don't get last year's dividends. Just preferred would, and so you hope everybody's on the same page as you. And then the last thing with preferred dividends, they're stated in a way where, like I said before, you'll know how much you're going to get as a dividend before it's even issued. One of the ways, let me go ahead and put this in here. Shares may say like this. You may say issue 50 shares of preferred stock at, let's say we issue them at $50 par. So they usually have a much higher par, and they'll pay, it'll say, well, we can look down here, at 10%, $50 par. That percent tells me right here, this will tell me how much in dividends I'm going to get. They usually have a percentage in front of the par, and that's going to say that I'm going to get 10% of the par value, so that's $5. So for every share I own, I'm going to be getting $5 in dividends as long as dividends are given out. That's how you have, that's why I say when you're going to know what preferred stockholders are going to get. Okay, so let's go down now and look at actually issuing stock. Stock is generally stated at a par rate. This is kind of almost an outdated term. We still use it to get to a real, hopefully a layman term understanding. Par basically means that's the lowest that the stock could initially be issued for. Let's rephrase that. Basically, minimum price could be issued for. So when it's first issued, it's going to sell for at least the par value. If it's not that, then they wouldn't even sell it. And that's how we're going to base how we list our stock coming up. So we're going to list stock based on these two categories when we sell stock. We're going to have it at the par rate, which is usually a pretty low dollar amount, like $1. And then anything else that the actual stock sells for above $1 goes into this category. And the terminology may be a little different. It may be just paid in capital. It may be, like I have here, additional paid in capital. APIC is usually how I abbreviate that. So any amount that the sale price is over and beyond the actual par value goes into this category. So usually this category is quite higher than the par value. So let's look at an example. If I sell 10 shares of $1 par common stock for 10 bucks a share. So this is the initial offering price, 10 bucks, and I decide that I'm going to sell 10 of those. So I'm selling 10 shares for 10 bucks each. So what did I get? Our debit question. I get cash 100 bucks. And where that cash came from, so our credit question came from two different places. First off, it came from the common stock account. This would be our issued account. When our stock is issued, it's going to go in here. And this number isn't going to change until I retire it. So my common stock is issued at $1 par. And if I only sell 10 shares, that's going to be 10 times 1. And that's where this $10 comes from. The rest, since I sold it for 10 bucks a share, I only accounted for $1 of that. The remaining $9 goes into my additional paid-in capital for common stock. We'll have an additional paid-in capital for different types of stock, so that's why I want to show that it's additional paid-in capital for this type of stock. Now, we not only give out shares of stock for cash, but you can also give it out for other items, as we'll show here on December 3rd. So December 3rd, we give out another 20 shares, but this time, and instead of the owners giving me money, they give me an item, a physical piece of equipment. And we value that item. It looks like it's going to cost normally about 200 bucks. So in exchange, since my stock is selling for about 10 bucks a share, I'm going to give them 20 shares. So I'm getting $200 in equipment. And in exchange for that 20 shares, I need to show that I gave them 20 shares at $1 par. And then the rest, whatever's left between the 200 and the 20, goes into that additional paid-in capital. Now there's one other item that you can issue stock for, and that would be to set up a corporation. There are a lot of little expenses that come along, like attorney fees. There's setup, like organizational type fees. And that's where this one comes into play. A lot of times an upstarting company may not have a lot of cash to pay some of the expenses. So instead, they'll try to negotiate with whoever's providing them a service and say, if you provide this service, we'll give you shares instead of cash, which hopefully those shares will go up in value and you'll actually make more money. That's the hope. So if you are paying for some startup fees, we don't really classify those separately as legal or accounting or whatever. We group them all into this organizational expense. And they would have normally charged us $400. So we offer up them a deal and say, we'll give you 30 shares. And so we multiply that by $1 a share. And then whatever's left goes into our additional paid-in capital. Now, so far, we've only been issuing common stock. On December 5th, we decide, well, I'm done issuing ownership. I want to stop the ownership. But I still want to issue and still get some money up coming in, and maybe even a lot more money than what I have been doing. Because those shares have only been selling for about 10 bucks a piece. Let's issue what we'll call preferred stock. And this preferred stock, they don't have any ownership rights, but they will have guaranteed upfront dividends. Now, I shouldn't use the word guaranteed. They're going to have dividends first if we do pay out dividends. They are the first ones to get it. And I would normally put here, we've sold 10 shares at 10%, $50 par, maybe cumulative preferred stock. So that makes the stock even more valuable. Because this is going to say, if I don't give you dividends this year or even next year, by that third year, before common stock did anything, you get those last 2 years first. And then you get this year's as well first, before common get whatever's left, which probably won't be very much. So we sell 10 shares of 10% $50 par stock. This 10% is simply telling me how much in dividends I'm going to pay those stockholders. They're going to get 10% of the par value. So 10% of 50 is $5. So when it's time to issue a dividend, I need to go back and look at what I sold the stock for to know how much my preferred stockholders are going to get. Okay, so the shares are selling for $75 each, and I'm selling 10 shares. So what am I getting? That's my debit, cash, 75 times 10. And then I'm going to list the preferred stock. I sold 10 shares at $50 par. So 10 times 50. And now I have a separate additional paid-in capital account for just the preferred stock for whatever's left. Okay, treasury stock. Treasury stock is when the company buys back their own stock. So this is not a new category of different stock. This is the company buying back whatever they have originally sold. And they'll do that for different reasons, but maybe it's they just don't want that many owners out there. They want to have it more in-house control. That could be a big reason. Could be dealing with stock price. If they buy back some of the stock, that means there's less out in the real world. And so, just like with any economics would tell you, if there's less out there, the price goes back up. That would maybe be another reason. So treasury stock, when we buy it back, it's not an asset. We're actually going to use it as a contra account to owner's equity. Contra stockholders equity account. It's going to reduce the value of my owner's equity. Let me take this out. Oh, no, I know what I have that for. I could have put the word in here. If a company, or now let's put in here, when a company resells their treasury stock, I'll abbreviate that, and it's above purchase price, this will not be considered a gain, because you basically are selling a piece of yourself, and you can't have a gain in yourself. You can only have a gain when selling something that you own, like assets. And if you have if you do have this, what seems like a gain, we don't call it that. Where we put that to is to additional paid-in capital. So the actual gain goes to the APIC for treasury stock. This is just like when we had additional paid-in capital for common stock, same thing for treasury stock. If we resell below the purchase price, then we're going to take away any paid-in capital from our treasury stock. And if that gets down to zero, we can't go below zero, then we're going to take the rest of it from retained earnings. So let's look at an example here with treasury stock. So we're using the same basic parameter of what we were doing, selling stock for the $1 par. But now we're going to buy back 5 shares of common stock, and the current market price is $15 a piece. Notice there was no mention of par here. When you're dealing with treasury stock, par isn't involved. Par is only involved when we actually sell the stock for the first time. When we buy it back, par is no longer really relevant to us. So we're going to simply list the stock at what we paid for it. So we're going to list the stock here called treasury stock. This is a contra owner's equity, $75, and then show that I had to pay cash to get that stock, those 5 shares. Now let's say the market's starting to go up, so we're going to sell one of those shares We originally bought it for 15. Now we're going to sell a share for 20. So the question then, what did I get? I got cash for 20 bucks. But notice I'm going to get rid of the stock at what I bought it for. Just like inventory when we do cost of goods sold. I don't want to put the inventory leaving the store at my sale price. I want to put it at what I originally bought it for. So I'm going to get rid of 1 share of Treasury stock for that 15 bucks. And then whatever's left, that goes into that additional paid-in capital for Treasury, which is almost like a gain. But we can't call it a gain because it's a stock that we hold that's our own stock. So right now we have this somewhat gain. Now, December 12th comes along and I need even more cash, but the price for the stock has went way down. It went down to 10 bucks a share, but I still need the money. So I'm going to go ahead and sell 2 more shares of stock to get 20 bucks. Well, those 2 shares, when I get rid of them, I'm going to need to credit my Treasury stock like I did here, but I sold 2 shares, so that's 30 bucks that I'm getting rid of in Treasury stock. So I'm looking at, obviously, a loss. I sold it for 10 and I bought it for 15. So what I have to do for losses is the first thing I do is I remove any additional paid-in capital for the Treasury stock that I originally had. So I remember from back here I had 5 bucks of this so-called gain. Well, now I want to get rid of that gain. I no longer have a gain when I'm looking at it in total. Not only do I not have a gain, I actually have a little bit of a loss between the 2 transactions. And if you do have a little bit of a loss left over, we're going to then take it out of our retained earnings account. We never want this APIC to go negative. The only thing that can go negative potentially is our retained earnings. Now, what I would recommend for you is to go back and do some T accounts and update our T accounts for each one of these owner's equity accounts. Because next, what we're going to look at is how to present this on the balance sheet. So if we go through, we have common stock of 10 bucks, common stock of 20 bucks, common stock of 30 bucks. So right now I have common stock of 60, and I keep looking down. I don't have any more common stock. So the first thing when I'm looking at my owner's equity account, I'm going to show that I have $1 par common stock, 60 shares were issued because they were $1 a piece. That's one of the reasons how I knew it was 60 shares. And as I just calculated when I went through, there was $60 in common stock in that T account. Next, we go to our other type of stock, preferred stock. You want to list that next. And I only had 1 preferred stock, and I had 10 shares of it at 50 bucks par. So 50 bucks par, this should say 10. So I had $500 in my preferred stock account. Now I go to the additional paid-in capital for common. Here's additional paid-in capital. I had 90 plus 180, so that's 270. 270 plus 370 gives us the $640 additional paid-in capital for common. I look back up to the December 5th, and I had a $250 in the paid-in capital for preferred. Next, we would list our retained earnings, and that's going to have to be given to you. I didn't give that to us in any of our examples so far, but that would normally be given to you. Treasury stock, well, we're going to list how much do we have left. Remember, I bought back 5 shares. I resold 1 share, 2 more shares. So I still have 2 shares of Treasury stock at 15 bucks each when I originally bought it for. So I still have a negative $30 out there for Treasury stock. And then the book will have you list this one extra item of the accumulated other income, comprehensive income. I'm not real big on that for right now. We don't need to cover that. Okay, the last thing we're going to cover for this chapter is dividends, and there are two different types of primary dividends that companies can give out: cash dividend, and then the second one would be issuing a stock dividend. A stock dividend would be, instead of giving your shareholders cash, you give them more stock. So the whole purpose then is to hopefully that stock is worth something, and so if the owners decide to turn around and sell the stock, they can still get money. Okay, so dividends, this is one of the items the board of directors will decide, and a lot of it's going to be based on how much money is coming into the company. Of course, you don't want to pay a dividend if you're losing money. You can pay a dividend if you're losing money, but it's not real good. So, okay, some of the reasons, some of the things you can do with dividends and your net income. Net income is basically, if you have your own sole proprietor business and you had income of $30,000, well, that's how much money you made for that year. You made $30,000, so that's your money, and you can do with it whatever you want. Do you want to keep it for personal purposes, or put some of it back into the business and grow the business? And that's what the board of directors is going to decide. How much of that net income do I want to give out to my owners, people who are investing in my company, or how much of it do I need to reinvest in the company to make it even bigger and better for later? Okay, so steps in issuing a dividend, we're going to decide that the board will say, we're going to issue this much in dividends per share on this date, and whoever owns the stock at this other certain date, maybe it's the same date, they're going to be the ones who are going to get the money, and then we need to make a list and actually pay those stockholders. So here's an example. Let's say we had net income of $400. So that net income was $700 in revenue and $300 in expenses. So that gives us $400. And out of that $400, I declare $150 to be given out in dividends. So let's journalize this. Well, how we journalize net income. Remember back to the early part of the semester, journalizing net income would actually be done during the closing process. We're going to close out our revenue and expenses, and remember, we close those into retained earnings. So if I close out my revenue account, it was $700 as a credit, so I debit my revenue to get rid of it. I had $400 in expenses as a debit balance, so I need to credit those to get rid of it. And then what's left is an increase then to my retained earnings. If out of that retained earnings, that $300, I decide to issue $150 in dividends. So my retained earnings, if I start paying dividends, that's going to make my retained earnings go back down a little bit. Now, we could call this a debit to dividends and then later close that dividends to retained earnings. But the book, for purposes, is just skipping the whole dividend account and going straight to retained earnings, which is fine. I kind of like to call it what it is up front and then close out the dividends later. But they're going ahead and assuming they're closing out the dividends right now and debiting the retained earnings to show that our retained earnings is going to go back down by $150 for that money that I'm going to pay out at that date whenever the board decides that they're going to make the payment. So that's pretty easy here, debiting the dividend or retained earnings account and then crediting either cash if I'm paying it right now or dividends payable if I'm going to be paying it in the near future. Okay, so stock dividends is the other way to issue a dividend and still give out something to the stockholders, but you don't necessarily have to give them cash. So this is kind of the things that happen here. Each shareholder remains their exact share. So everybody's going to get, if the company issues a 5% stock dividend, everybody gets an extra 5% of what they own. So if you own 100 shares, they're going to give you 5 new shares. So everybody gets 5 new %. So nobody has more or less than what anybody else did before the stock dividend. Everybody got 5 extra %. So their individual number of stock went up. They actually own now 105 shares instead of 100. But money-wise, the company didn't spend any money, so they don't have to worry about the cash part. All right, so let's look at this example. The company issues a 10% stock dividend. The stock is currently selling for $30 a share. Common stock outstanding, so that means what the public still owns, is 1,000 shares. So out of the 1,000 shares, we're going to issue 10% more. So whoever owns these shares, if they own 10 shares, they're going to get 10% extra, which would be 1 more share. So if we issue 10% of 1,000, that means we're issuing out 100 shares. If we're issuing out 100 shares and those shares are selling for $30 a piece, I'm actually giving up $3,000 in retained earnings because I'm giving up $100 in capital stock, common stock. And remember how that $100 was got from up here, $1 par. I gave out 100 shares times $1 par, and then all the rest of it goes to my additional paid-in capital stockholders. My debit here is reducing my retained earnings by that $3,000 in ownership that I gave out. So how this affects then my dividends. So before the dividend, as I tell us here, we had 1,000 shares at $1 par. And this, I had to give you these two amounts. These two amounts would just have been given. So we have total, oops, forgot to change that. We have a total stockholders' equity of $41,000. After the stock dividend, I now not only have 1,000 shares, I have 1,100 shares at $1 par. So my common stock has went up by $100 because of my journal entry here. My additional paid-in capital has went up $2,900, so it went from $10,000 to $12,900. However, my retained earnings went down by $3,000, so it went from 30 to 27. When you add up all of this, it still gives you 41,000. So, even though the individual accounts change, the overall stockholders' equity stayed the same. So all I did is move money around. I moved it from retained earnings into the stockholders. They now own a little bit more of the company. The last thing to talk about is stock split. Companies do this to hopefully make their shares more attractive, to make them a little bit lower in value. Once the company stock gets so high, usually investors will start to get scared away and they won't buy the stock, or it won't become as attractive to other investors. So if we had stock selling for $100 at $10 par and we issued a 2-for-1 split, meaning for every share of stock that's out there, there will now be 2 shares. So if there was 100, now there are 200 shares. But to offset that, each share now is only worth $5 par. So 100 at $10 par is $1,000 total common stock. 200 at $5 par is still $1,000 common stock. So nothing really changed on my books. The only thing that really changed was the par value and maybe, and then more importantly for the investors, the purchase price. So if there are 200 shares, remember basic economics, the more items that are out there, the lower the cost becomes. Just like with gasoline, if lots of people are pumping it out of the ground, the oil starts going down. But if very few companies are pumping it because of war or whatever, there becomes a lot less oil, more people, price just goes up, supply and demand. So if there's more supply, the price will go down. So let's look at this example to finish off. A 2-for-1 stock split was declared. Currently, the stock is selling, remember our prior example, 30 bucks a share. Common shares currently out there were 1,000 shares at $1 par. So I had here's my 1,000 shares at $1 par value, and then the two that I told you I just give you the information. If I issue a 2-for-1 stock split, now instead of being 1,000 shares, there are now 2,000 shares, but the par is cut in half. So 2,000 shares at $50 par still gives me $1,000. It's just my par value was cut in half and my number of shares was double. So as you see, nothing changed within the individual counts. So then nothing changed with total stockholders' equity. The only things that did change were my par value, and the fair market value of the stock should be about half, depending on the market, but should be about half of the selling price. Okay, the last thing that I want to do is we're going to look at some examples of today's homework. So while I bring that up, I'll quickly pause. Okay, so I'm pulling back up the homework, and I'm looking at the third one here on this week's homework. So there's a couple things we need to know. We're going to need to know some of this stuff here, especially the par value of our common stock when we start doing some of the journal entries. And then the second thing, it tells us we want to journalize the transactions in B, C, D, and E. It's not having us do A. A would be our net income. That would be a closing entry. We could do that as a closing entry, but they didn't want us to do that here. So let's go ahead and look at how we journalize Part B, issuing 6 million shares of common stock for $14 a share. So you ask yourself, what did you get? You got money. You got cash, 6 million, so I got to pull out my calculator. 6 million shares at 14 bucks each. So that would be big numbers here. 1, 2, 3, 4, 5, 84 million in cash. And then how did I get the stock? Well, if we go back to my notes, remember we issue it first at common stock, and we do that at par. So I pull up to see the par value is $1 par. At $1 par, and I issued 6 million. So this number would be my 6 million, 6 million times $1. And then the rest is my additional paid-in capital. So that would be the remaining amount. So that would be 78 million. Oh, what did I do here? Oh, I missed a zero. Not 78, 780 million. Oh, wait a minute. Let's see. We had, make sure I got the right numbers, 6 million shares of stock selling for 14 bucks. 6 million, 1, 2, 3, 6,000, 60, 600, 6 million times 14 bucks a share. That's 884. Yeah, no, that's 84 million. 84 million minus 6 million. It's 78 million. I should have got that. Let me see if I maybe put too many zeros. 8, 4, down. There would be a comma. There would be, that should be right. And 60 million should be right. Oh, okay. Good thing we went over this. They want us to enter in the amounts in millions. So I actually thought that meant putting it in millions. They only want you to put it as, if it was 84, just putting 84. Kind of confusing. But, all right, we can work with that. So we'll know how to do that for this one. So this is a good thing that we went through this one, so you won't miss that. Purchase 3 million shares of Treasury stock for $36 million. All right, so Treasury stock, remember we list that on our books at what we actually bought it for. Par value is not really important here. So 3 million shares at 36 bucks each. So let's do the math. 36 times 3 is 108. 108 million. So they just want us to put 108. And we purchased. So that would be a credit. How did we get it? We got it by paying money. Oh goodness! Now what did I do? All right, let's work this one out. 36 million. Oh! I see what it's saying. It's not 36 per share. It's for 36 total. Man, I'm not having a good day so far. We purchased 3 million shares for 36 million total. So if it comes to be later, I could easily decide. I could easily know that each share cost me 12 bucks just by doing the math. 36 divided by 3. So 36 divided by 3 tells me they were 12 bucks a piece. Sold 1 million of the shares in Part C for 15 million. All right, so this is where I think it's going to be important. Let's see how it works out. Again, this is the first time I'm going through these with you. So if I had them for 12 bucks a share, and now I'm selling them for 15 million a share, basically 15 million, and I'm selling 1 million of them. So I'm getting cash for 15 million. I'm getting rid of treasury stock, and this is where it was important to know how much they cost me a piece. So they cost me 36 million, and I got 3 million shares, so that's 12 bucks a piece. So when I get rid of the stock, I'm going to get rid of them at 12 bucks a piece. And since I only got rid of 1 million, it's just the 12 million that I'm getting rid of, the 12 here. And then the remaining of that $3 that's left, that's my additional paid-in capital for treasury stock. Kind of like a gain. Okay, probably I think this is the last part, A, B, C, D, E, yeah. Declaration and payment of a cash dividend of 34 million. So this is declaration and payment. So I'm going to actually probably credit cash. So journalize the declaration of the dividend only. All right, so that's telling me, I don't know why they told us payment, but so declaration of the dividend only. So we're not going to show that we lost cash yet. We're going to do a dividend payable. Cash dividends of 34 million. Notice they don't even give us a dividend option. We're just going to go ahead and debit the retained earnings as I showed you in my notes for 34, and we're going to call this dividends payable because it's not paid yet. And then finally, on the next one, we're going to do pay the dividends. So debit the dividend payable for 34 million, credit the cash for 34. Okay, we'll leave that. Let's move on. Okay, this one is dealing with how do we know how much dividends are going to be given out to our shareholders? So let's look at this again. Preferred stock has $6 par, 7%. So preferred stock is going to pay 7% of $6. So 0.07 times $6 says for my preferred stockholders, you're getting 42 cents per share. And common stockholders would get whatever's left. All right, so compute the total amount of dividends to both preferred and stock for preferred and common stockholders for 2014 and 2015 if dividends are $60,000 and $90,000. So we're going to do 2014 first. If I give out 42 cents per share to my preferred stockholders, and there are 40,000 shares to give out to, so we take 40,000 times 42 cents per share. That leaves 16,800 to my preferred stockholders. And then whatever's left out of the 60 would go to my common stockholders. 43.2. So your ending here better be 60. Uh-oh. Let's see what we did wrong. Okay, let's go back up here and make sure I calculated everything right. Preferred stock, cumulative. That could be key. Let's see. $6 par, 7%. All right, I think that's what I did, but we'll check it. 7% times $6, 42 cents. 42 cents a share. Okay. So 42 cents times 42 cents times 40,000 shares. Make sure I'm not missing anything. Oh, I see what it is. This was the key thing that I missed. This sentence right here. The manufacturing company has paid all dividends through 2011. So that means the company has not paid dividends for 2012, for 2013, and now this year, 2014. So when I showed that the company was supposed to get 16.8, that's just this year. And when I look at their preferred stock wording here, it says cumulative. So they're supposed to get 16.8 for 2012, which they didn't get, for 2013, which they didn't get, and now for 2014. So 16.8 times 3 years, my preferred dividend holders should have gotten 50,400. And then whatever's left, the 9,600, goes to my common stockholders. So that was the key part of that one, is knowing that it's a cumulative and that we only had paid up through basically 3 years ago. Now for 2014 or for 2015, all the dividends are paid up. So my preferred stockholders are only going to get what I had originally calculated. So that, let's see what that was, 16.8. Preferred stockholders this year get just their 16.8. And my common stockholders are going to really do well this year when they get the rest of the 90,000. So 16.8 minus 90,000 is 73,200. And there we go. The last item on this one is they want you to tell if we pay a cash dividend of $77 million, how does that affect my stockholders' equity? Does it make it go up, down, and by how much? And so what might help is if you do a journal entry. Remember the journal entry for issuing a cash dividend. We would debit our retained earnings, and then we would credit cash. So if you're going to debit retained earnings, that's going to lower your stockholders' equity. And it's going to lower it by the full amount, $77 million. I'm going to guess, yeah. So this one they actually told us how to do it. I wish they would have told us this in the other one. For 10 million, write 10. Well, let's see. Declaration of cash dividends of 77 million. Let's see. Decrease 77, for example. 10 million is 10. 77 million, that should be 77. I don't think they want to put a negative, but we'll check. No. What do they want us to put here? Oh, goodness. I read it wrong again. Okay, so this one, they actually do want you to type it all out. 77. I thought, good thing we're doing this. Example 3. Remember, that was just entering in the number, 77. This one, they actually want you to type in the whole thing. 77 million. I wish I would have read it a little more carefully. Payment of the cash dividend. If we're going to pay a cash dividend, that's just going to affect our assets and our liabilities. So no effect. And I'll let you do the rest of them now by going through this. I will we'll call off this lesson here. Obviously today I wasn't at my best, but you know, I have not so good days. And but hopefully you got something out of this through my mistakes, and hopefully you won't make those same mistakes. All right, we'll see you next